What's going on, guys? All right, so I know you hear Donald Trump say that the economy is doing great, the stock market is making record highs, there's no need to worry about a recession. That's not necessarily true. What we actually have is a bubble masquerading itself as economic growth. So what I'm gonna do, I'm gonna give you guys the 5 signs of recession and what you can do to move forward. All right, before we get started, I personally feel that we are already in a recession. However, if you go on CNBC, you may hear people like Stephen Moore or Larry Kudlow, who is the chief economic advisor to Trump. They'll say things like, the economy is doing good, the economy is doing great, there's nothing to worry about. These are the same guys who are saying the economy is doing good, the economy is doing great, there's nothing to worry about. Back in 06, back in 07, and even early 08. And we both know what happened at that time. What's funny is this, the government actually stated that after doing the numbers, we're in a recession 6 months prior to them announcing that we're in a recession. So the next time you hear people on CNBC like Stephen Moore or Larry Kudlow say, the economy is doing great, the economy is doing good, there's nothing to worry about, just think about that. All right, so let's start it off with the 5 signs of recession. So number 1 is the record high in debt. Now, it's student loan debt and also credit card debt that's the main things I want to focus on. Now, let's first start with credit card debt. Now, the rise of credit card debt is showing that Americans are just not making enough to cover their entire credit card balance at the end of the month. This is resulting in a rise of credit APR. This is a huge sign. Now, with record high APR as well as a rise of APR, it's showing that banks need more leverage. Americans are just not paying everything off in full, and the regular APR that they have wasn't cutting it. Banks need more leverage. If they're going to give out all this money in the form of credit, which is not real money, if they're going to give out all this money, they need leverage. So that's the reason why they are rising the APR, guys. Now, the second form of debt that I want to focus on this first sign is student loan debt. Now, student loan debt is the highest it's ever been. And this is not only because of the high interest that they have, this is also because students are just not making enough money to cover their debt. Now, students are graduating but not landing occupations within their field. This is resulting in them having to go outside of their field, something that may be below them, just so they can have a job, so they can cover their means. This is not good, guys. If your degree says that you should be making minimum 6 figures, however, you can't get an occupation in that field and you have to go outside to get another occupation, that's not a good sign. What's that showing is that now you have to accept a job that's going to be giving you low 5 figures just to cover your expenses, just to make sure you have a job. Now, this 5-figure job does not cover your 6-figure student loan debt that you're currently in. If you landed that 6-figure job, that would be beneficial. Why? Because now you can pay back that student loan, which shows that you should be making 6 figures. However, when you decrease it to 5 figures, that student loan debt does not decrease. That student loan debt remains the same. So now you're stuck just barely being able to pay the student loan debt, and that's going to be a rise of student loan debt as well as the high interest. Now, this is resulting in you not being able to pay off your student loan on time, which is causing a high interest to be added to your already balance. Now, the second sign I want to go over is the rise of our debt ceiling. Now, as I'm recording this video, we have a record high. We have a record high of $22 trillion with a T, trillion dollars in debt. What? Now, here's an example to just show how we got that number. Now let's use credit card utilization as an example. If you have a credit card limit of $10,000 and you have a balance of $2,000, you currently owe 20% utilization on that credit card. Now, if you call to raise your credit card ceiling or your credit card limit from $10,000 to $20,000, you now went from 20% utilization down to 10% utilization. However, your balance still remains at $2,000. Now, what this is doing is giving you the illusion that you have more money. In reality, you don't. You just raise your ceiling. You just raise your limit. So now with that extra $18,000 that you have to spend, you're going to spend it. So right before you max out at $20,000, what do? You raise your ceiling or you raise your limit once again. So now you're going from $20,000 to $30,000, but now you owe $18,000 still. That balance does not decrease. That balance remains the same. Our government has been doing was just increasing that ceiling every time we get close to paying it off. That's a bubble, guys. That has to get paid. What do you think happens if we owe $18,000 and it doesn't get paid? And we just raise it. Now we owe $30,000. It doesn't get paid. We just keep raising the debt. Now we owe $100,000. Doesn't get paid. We keep raising the debt. Raising the debt is not a sign of an economy that's doing good. That's a sign of that a recession is coming. So now, time for number 3. The third sign of a recession is the unemployment rate. We are currently at a 50-year low of unemployment rate and a rise of minimum wage. However, we're still cutting rates. Why are we cutting rates if we're at a 50-year low of unemployment and we have a rise of minimum wage? A 50-year low of unemployment rate and a rise of minimum wage show that the economy is booming. However, what we currently have is a booming economy. Now, in a booming economy, you're not going to cut rates. You're going to raise rates. In a rare booming economy, what the Fed would do, the Fed would raise the rates. However, as I just said, what we have been doing is cutting rates. You don't cut rates in a booming economy. You cut rates in a booming economy. Now, the fourth sign of recession, the yield curve. So recently, the 10-year yield curve and the 2-year yield curve have inverted. So this is showing us that a short-term investment will give us a better return than a long-term investment. A short-term investment give us a better return than a long-term investment? Now, before we get into that, let's actually speak about bonds. Now, bonds are a chunk of money that an investor lends a company or a government with the agreement that they'll be repaid over time with interest. The interest or the amount of money that an investor earns annually per $100 worth of bonds is the yield. Now, a normal yield curve shows economic growth. If I give you money, I'm going to expect in 10 years to make more money than I'm going to get in 2 years, which is normal. Once that inverts and it's showing me that in 2 years, I'll make more money than I'll make in 10 years, that's a problem. On average, after the 2-year and the 10-year invert, we're going to be in a recession 20 months after that. That's a sign. And now for the fifth sign of recession, heavy duty truck declines. Now, I actually saved this one for last because this is a major sign of recession. If you guys don't know what heavy duty trucks are, if you're ever on the road driving on a highway, you see these large trucks, they usually have like Walmart, Amazon, Home Depot. These are heavy duty trucks. Now, if those are declining, that's not a good sign. That's a sign of a recession. For the past 11 months, heavy duty truck orders have been declining and they continue to decline. This is showing that companies do not need to transport goods as much. If they don't need to transport goods as much, then that means that people aren't making enough money because they can't afford to buy more things. But the economy is booming. So guys, the next time you hear someone say the economy is doing great, the economy is doing good, think about these 5 signs of recession.